Here we go. All right, so life insurance is the last piece here. Much of what I wanted you to do very early on in the first week was to learn about risk and the basics. So this was sort of covered already. I'll review it quickly, and then we'll go through some of the basic issues regarding life insurance. Okay, so basically the purpose of life insurance is to replace any lost income in the case of premature death. Okay, and that only matters if people are dependent on your life. So you have, you have children, you have a spouse up until this point where they've depended on your income based on your arrangement. Um, this is really the purpose of it. If your life were to be prematurely cut short, what type of financial loss would there be? So, again, this usually happens when you start thinking about it when you get married, or if you have a significant partner. There's a lot of unmarried couples that have children together and stay together for a long time. So you start thinking about these things once you're in something very serious. You have children, you have other responsibilities like large debts, like a house or something like that, that you don't want anyone to lose should you not be there. And so this is really sort of the purpose of it. Okay. All right, so this we've talked about already. It's the beginning of what it is. Risk. It's about uncertainty, not knowing, things happening by chance, creating an economic loss, right? You can avoid certain risks by not doing things. You can avoid being in a car accident by never getting into a car. But you might get into another vehicle that might get into an accident. So, I mean, the idea of avoiding life is highly unusual and unlikely. Basically speaking, we know that there's risks in everything. We've been talking about a lot of different things. This particular chapter is focused on the life insurance issue. But basically, they talk to you a little bit about, how much risk you are actually assuming by not looking at these things. Right? So we talked about that with your auto policy, your renters or homeowners policy. There are lots of other types of things, disability, for example, from last class, that you're just assuming the risk. It doesn't mean the risk has gone away. It means that if something terrible to happen, you are assuming the loss. You're not lessening it in any way, shape, or form. Insurance involves transferring some or as much of that risk as possible to a third party, the insurance company, into a group. And so you are basically, the purpose of insurance is to help you offset that risk of loss. And of course, it's very, very difficult for anyone to transfer 100% of the risks that are involved with anything, because ultimately your actions still matter in what you do. The process of a company, an insurance company, writing an insurance policy on you is the process of underwriting. Part of that is they look at whom they can insure, the risks that are involved. They then calculate how much the costs would be to them and how much they would need to charge you in order to make sure that they would cover those costs and make a profit. And so the premium is sort of based on that. One of the interesting things that happens early is insurance companies that do underwriting, they really want to avoid what we call adverse selection, which means basically the number of people in the insurance pool are the riskiest. And this is what happens when you offer, this is the problem, financially speaking. Uh, if you just offer insurance, health insurance, for example, for people who don't have it, instead of, as Obamacare tried to do, force everyone to have it. Well, if you just give health and if you just offer life health insurance to anybody, the first people in are going to be the people that are sick. They're the ones that need health insurance right now. Um, if everyone else is in good health and they don't buy insurance, then the only people that are in the insurance pool are the riskiest, and thus insurance cannot work. Insurance cannot work if only the riskiest people are in the insurance pool. Everybody has to be in. That was the idea behind the Affordable Care Act, is you basically force everyone into the system, because now you can underwrite, you can actually insure things more properly. You can understand who you're insuring, what the rate should be charged, what the risks are, et cetera. But when you just leave it open, then usually the first people that are in are the ones that have the risk, are the riskiest ones. Okay. Again, they are classifying, they are charging people based on risk, as we talked about. But sometimes it can be unbalanced. So let's focus on life insurance now. Again, it's protection for your dependents. That's the loss. The loss wouldn't be for you, you'd be dead. The loss is for who is relying on you in terms of a financial provider. So usually anyone who is a dependent is going to suffer the greatest loss. And so that financial protection comes in the form of life insurance. In some cases, life insurance can be used to protect protect creditors. Because basically, well, it's a protection from creditors, because basically the benefits are paid of a life insurance policy to your beneficiaries, the people who are normally speaking your dependents. And thus, that money is not accessible to creditors. In the case you do die and you owe debt, that life insurance proceeds are not part of your assets. So the court cannot discharge those proceeds to pay your debts off. They have to go to your beneficiaries. And so creditors will not be able to access life insurance proceeds because they technically don't belong to you. They will be paid to your beneficiary. One of the benefits of getting that payment from a life insurance policy, which are called proceeds from an insurance, they are overwhelmingly not taxable. So for folks that are getting, in some cases, most people decide to get a lump sum payment, which means they're getting the full value of the policy up front once the person dies and it goes to the beneficiary. That money is a lot of money up front, and it's not taxable. Okay. Life insurance can be a way to save money, but it's not really the best choice for that. So the questions about it: do you need it? Do you need it? Well, if you have dependents, yes, for sure. Some people would argue that if you have debts like a home mortgage, that you don't want that to be lost. In other words, you want your beneficiaries to stay in your home, and the only way they will do that is if that debt is covered. Well, then, sure, then life insurance can be used for that as well. No, you don't need it if there's no one depending on you for financial support. You just don't need it, because if you died, it would be tragic. But at least no one would be, no one would be worried about how they're going to pay the rent or put food on the table, because they never depended on you for that. So even though you're not there anymore, that need doesn't change. And if you're a child, one of the biggest things that I see sometimes still on television is Gerber. You know, they make all the baby food stuff. Uh, you want Gerber baby life insurance for your child. It's just such a ridiculous thing. You know, it really is. Babies do not need life insurance. Children do not need life insurance. Um, and, you know, it because 99.9% of kids make it to age 18. So think about it from a business perspective. You're a life insurance company. You're selling baby life insurance. Okay, $99.90 out of every $100 you collect is basically part of your profit, because 99.9% of these kids that are insured with baby life insurance are going to make it to 18. And so it's crazy. It's great for it's a good business thing. I mean, they're making profits from baby life insurance, but you don't need it. Parents don't need to buy insurance on a baby, unless, of course, they make money on that baby. In other words, that baby is a movie star, and the parents are relying on that baby's movie stardom to make a living. Well, then you could argue there's a case for life insurance there. Although you could probably argue better that there's something wrong with the parents, for doing that. You know, they can't survive on their own, so obviously they're dependent on their kid. Um, but generally, no, no. Some people like to have a small policy because well, I'll have funeral costs, and if I die, I don't want my parents to or my family to pay for my funeral expenses. Okay, but you don't really need a lot. The average funeral is about 8 grand, and that's if you have most of the things that traditional people do with funerals. They have a wake, and they have a ceremony, and they have a burial, and they have this, and it's about 8 grand, give or take. Um, you don't need $1 million to bury yourself, for sure. So yes, that's reasonable, but it's not always necessary. So how much life insurance people need? The most common thing to do is simply to take your annual income and multiply it by anywhere from, they say, 5 to 10. Again, like it's relatively arbitrary because you're sort of guessing. You're sort of guessing. But a lot of people use it because it's easy to do. If you take your income, $50,000 a year, and you multiply it by 5 to 10, you're going to need between 250,000 and $500,000 worth of life insurance. But do you? But do you? So yes, it's easy, but it's not accurate. The best way to do it is to actually sit down and do it the long way, which is called a needs analysis. What is it that you need? What is it your family would need if you were not here? You know, would you need to pay off the mortgage? Would you need to take care of your children for so many years until they are out of school or out of college? You plan on paying for college? That should be in the needs analysis. Uh, does your spouse need to go back to school to get a job, to be retrained? Is it going to take a couple of years? You're going to pay those expenses for a couple of years, and then he or she will be able to manage the financial end better. That's a needs analysis. Um, are you getting any benefits from work? And that lowers your need. Are you getting any benefits from any other policies that you have? That lowers the need. Is your family eligible for Social Security benefits or other survivor benefits? Anyway, that's going to lower your need. So a needs analysis is a very long way of doing it, but it's the most accurate way of doing it. Okay. And there's a worksheet in the book that you can look at in order to actually determine what the needs are, what the financial resources are, and how much you could really life insurance you're really going to need to cover the difference. It's your book says there's actually three types of policies. There's actually basically two, temporary and permanent insurance, but they have different names. So term life insurance is simply a temporary insurance policy. It covers a year and it can be renewed year to year to year until you're a certain age. Um, Whole life policy and universal life policy are basically permanent insurance policies. They are permanent life insurance. You'll have these if you want for your entire life. Okay. But I'm going to be sticking with just to look at term and temporary and permanent term and whole life policies in the discussion. If you get that down, you'll be great. Okay. So again, term life insurance, just where the word term is it's for a specific period of time. So the terms are usually 1 year. And the benefit, the life insurance gets paid if the insured dies in that time period. Otherwise, there's no benefit that's paid because, of course, you didn't die. That's the whole purpose of it. You do not ever want to say this is a waste of money, to have the term life insurance because you don't necessarily want to die prematurely. And so, yes, it's always a good thing not to die, particularly if people are depending on you. So, but the benefit, the insurance policy covers you in that time period. Oftentimes, these time periods can be renewed. You can just simply renew it every single year up until a certain age. The issue with term insurance is it's very, very cheap when you're young. It's very, very expensive when you're old. And that's because they calculate basically when you're going to die. Yeah, insurance companies have some weird, funky stuff going on. And one of the things they do is they use mortality tables. So based on the year you were born, your general health, all this other types of stuff, they project out, roughly speaking, when you're likely to pass. And thus, they want to make sure they're collecting enough money between now and then. For a term policy, it comes down to probability. What's the probability of a 30-year-old man, even if he does smoke and has, other issues, what's the probability of him dying this year? Well, it's pretty low. It can happen, but it's pretty low. So that means that the insurance policy will be cheap because there's a low probability that a 30-year-old, even if he does have risk factors like smoking, will die. However, if you're 60 and you are a smoker and you might be overweight or what like that, well, the probability that you're going to die that year goes way up. Because first of all, you're older, so you're closer to your checkout date. Two, you have these risk factors that can kill you any day. So, in that sense, the term life insurance will be very expensive for that person because they're simply closer to death. They simply have a higher probability. And so that higher risk means the insurance company is going to charge a higher premium to cover a higher risk. So term insurance policy comes in what we call either straight or decreasing forms, policies. Straight term, basically the coverage remains the same as you age. So if you buy a $100,000 policy or a $500,000 term policy and you renew it, it's just going to stay the same. You'll renew it at $500,000 for years and years and years. That means over time your premium is going to go up because again, every year you age, you're that much closer to checking out of the hotel that we call Earth, right? So that's how that goes. Decreasing term is actually quite reasonable because as you get older, you should have a lot less people depending on you. When you're 30, 40, you have kids and things like that. Yeah, you could have a lot of people depending on you for a time. But when you're 60 or 70, haven't your kids moved out? Haven't they at least started a career and they can, support themselves? Are they still, dad can have an allowance when you're 30 years old? Looks kind of, It's just, it doesn't look good. Let's face it. So basically, as you get older, of course, your house should be paid, or most of your mortgage should be paid. You should have less debts. You should be getting ready for retirement. So you don't need a lot of insurance. So that decreasing term policy basically fits that profile. And as the older you get, you have less dependence and you'll have less debt to worry about. And so you'll have less and less need for a large insurance policy. So thus decreasing term works quite well. The most important feature is renewability. You want to make sure that it's renewable term. And that means that you don't have to provide any evidence after you get a policy. You don't have to provide any new evidence to get the policy renewed year after year after year. Otherwise, you might need to go through things like a physical checkup or whatnot for if you start something like that, because they have to underwrite your insurability, and that means they need data, they need information. Another feature for term policy is sometimes you can actually convert your term policy to permanent, a whole life policy. Again, without any additional evidence of insurability, without going through another physical exam or questionnaire that's 1,000 questions long, to them to underwrite you for the beginning. So again, if you had a $100,000 policy and you were a non-smoker, so non-smokers tend to live a longer life than us smokers. So if you're age 25, and you're male, you're going to be paying $164 a year for that policy. If you're females tend to live longer. So the day in which you check out of Hotel Earth is later than men. And so the policy means you're less risky to die at this age, okay, than you are already at an older age. But look at the differences again. I mean, there's not much risk when you're 40 either. Okay, 40 might seem old. You're young. Get over it. However, again, it is higher. It is higher, but not terrible. But at age 60, woohoo! At age 60, your probability of kicking the bucket is much higher. And thus, they want to make sure they're grabbing enough money to cover that risk. And that's basically what they have. So depends on, again, the longer you have these policies, the more you're going to be, again, the older you get, the closer you are to dying. And thus, the closer they are to pay the policy. They have to look at it from a business perspective. When they pay the policy, that's an expense. They need to cover all of that. So they're looking at probability, and that's how they do it. Okay. Fascinating. So it's very economical, particularly for younger families. You can get a very, very large term policy for very little money. And so that's terrific. That is terrific. But as you get older, if you like to have that renewed, well, that's good. You can have it renewed. But it's going to cost you more because the longer you have the policy, the closer and closer and closer you are to mortality, and thus the risk goes up for them, and they're going to charge you. Permanent insurance, whole life insurance, is basically permanent insurance. It provides, when you buy a whole life policy, there's an assumption that you're going to have it for your whole life. So if you get it at age 20, the whole life really goes to about 80 in terms of premiums. So you're going to be paying a monthly premium to the insurance company for a whole life policy, but you're going to be paying the same amount of money per month at age 20 as you would at age 60, it doesn't change. It doesn't change. Another thing with whole life policies or permanent insurance is they build what's called a cash value. So they're actually an asset that's worth some money. So you can actually sell the insurance policy back to the insurance company for the cash value of the policy. They will give you that particular cash. You could also take loans out against the policy based on how much cash value there is. Okay. And then, that's basically what this is. You have a right to a cash value if you cancel the policy prior to your death. So that cash value is the only thing left of all the money you've given to them in premiums. Now it builds. I mean, it's not like it doesn't build. It over time it will build, as you see here in this chart. Cash value does build up, okay, over time. Here is a whole life policy for that same $100,000 non-smoker. Okay. As you see, the policy premiums are pretty high. Okay. So compared to the term life policy, which was about $160 or so, right, for the year, the whole life policy is $1,057 for this same person, $956 for the female, again, non-smoker, for the same policy. This is set for life. If you get life insurance as a female at age 25, this is your policy for life. Okay. If you buy it when you're older, you can still buy whole life insurance when you're older, but you're going to be paying a higher premium because, again, you're closer to checking out. The cash value over a period of time builds up. Okay. And this cash value basically can be sold off back to the insurance company. It can and return to you. Okay. But this is how it works. Your cash value, this is at year 20. So if you're that male, you've been putting in $1,057 every year for 20 years. This is your cash value in the policy. That's your cash value in the policy. So if you do sell the policy, this is technically how much cash value there is that you could receive, but then you wouldn't have any life insurance. So again, it's something to think through. Again, there are types of whole life policies as well, the straight life, and that's not meaning anything, with orientation. It's just continuous premium. Limited payment and single premium. There are different types, but it's permanent insurance. Whole life, one of the advantages is it does provide a value, so you do get some type of value. You can save money that way. It's not the best way to save money. It's actually one of the worst ways to save money, other than sticking it in your mattress. You can borrow against that policy. The whole life policy is an asset with that cash value. So again, you can use that as collateral and borrow against it. The premiums that you pay are going to be constant for your whole life until usually age 80, when you stop paying the premiums, although you still have permanent insurance. And again, that cash value continues to go up each and every year. Okay. But of course, the disadvantage is because it is so expensive, there's less protection for younger people, because a whole life policy is going to cost you a whole lot more than a term policy, and for lower coverages. It's terrible as a savings tool, but it's very low return. There are some tax penalties that are involved. If you do withdraw early, that money will be subject to certain taxation. And again, the premiums are very, very high. very, very high. Universal life is just another permanent policy. Works very much the same. Variable life is a permanent policy, but then you can, instead of your cash value, you can invest it in mutual funds. It's risky. It's risky. That also, if you're investing that, by the way, you're risking that you could lose value in your policy. So again, it's basically term, which is temporary insurance, and permanent insurance. All these would classify as permanent. Okay. The cheapest way to get life insurance is through your employer, because they get something called group life. That's the cheapest way to get life insurance. That's where I have all of my life insurance, because it's just so damn cheap. You can buy life insurance, of course, through an insurance agency that sells life insurance. That's another way to get it too, but this is the cheapest, through your employer. You're probably going to hear about other types of life insurance programs, like a mortgage life, credit life, industrial life. Well, industrial life is really for very low income families with a very small face value, which is $10,000, $5,000, small amounts. But this other life insurance is basically making sure you never really need it. Let's put it that way. Because all it really does is it ensures the lender that you're going to pay back the loan. So it's basically sort of ensuring that if you die, the bank is going to get their money back, or the creditor is going to get their money back. But you're paying the policy. Don't do it. It's just much better to include it, and that's why that needs analysis is better. You'll see all your debts, you'll see your mortgage, you'll see what you need to cover. But don't fall for this. You'll need life insurance on your credit. That's just crazy stuff. Okay, again, the most important thing is to make sure you understand your agent if you do want to buy life insurance. Again, the cheapest way is through employer, but if not, there's a lot of agents. You always compare the cost and the features. So very quickly, a couple of things. Yes, agents, it's interesting because I worked as a financial planner back in the 80s. And one of the things that we were told is to, of course, always try to sell whole life. Well, when I asked all of the financial planners in the office in near Boston, Massachusetts, what they had, all of them, every single one, had term life insurance. Not a single one had a whole life. So why do insurance agents want to sell you whole life versus a term policy? Well, the commissions are bigger. The commissions are bigger. So as an insurance agent, if I sold a term policy, I'm only going to get a very small portion of that as my commission. If I sell a whole life policy, I would tell you more than half of the amount that is being collected that first year is for me as the agent. That's my commission for selling it. So, so it's in my best interest as an agent to sell whole life to customers. Whereas if they'll almost always have term. So that's just something to watch for. It doesn't mean that whole life is a bad idea. It just means that you might not need it. You might not need it. So you got to be careful. There's always beneficiaries that have to be in the contract. All right. You have to pick, whether most people get a lump sum when they you can have other options. You can actually have the beneficiary get interest only from that. For a large policy, that could be a lot of money per month, per year. You could also get a fixed period where you can actually, or a fixed amount, where you want your beneficiary, say it's a younger child or or an older child, say a teenager, to get, you know, $300, $400, $500 a month, you know, from that. You can set that up that way. You can set it up that way. Or set it up to give them a lifetime income, depending on how big the policy is. Okay. So there's a few things, you know, loans and other types of stuff that I won't get into. But basically speaking, there are a lot of features you can negotiate in the contract. There's a couple of things I want to talk about here, and only a couple of things here. One is you can actually put a rider on the policy for something called multiple indemnity. It might only cost 10, 20, 30 bucks more, but it, in most cases, triples the life insurance policy if you die in an accident. And in some cases, if you work a dangerous job, if you travel a lot for work, if you do other types of things like that, it might be worth considering. One other thing too is you can't kill yourself and collect on an insurance policy. Most suicide clauses are at least for 2 years. Some of them run higher than that, longer than that. So that's one of those types of things where a lot of people get mistaken about that. But there are suicide. The insurance company knows it's a business. They know the risks. And so they're not going to pay if you kill yourself. One other thing is that insurance, you don't have to die to get insurance benefits for life insurance, but you have to be close to death. So living benefits are basically if you've been diagnosed with something that's going to kill you in the next 6 months or so, then the one of the policy features is the insurance company will give you most of the insurance benefit up front. So you can use it to, I don't know, pay for medical, end of life, whatever stuff. And that's what a living benefits feature is. I think almost all of them have it. I would be shocked if they don't. One thing you have to watch out for, I don't know if you've seen these stupid commercials on television if you watch TV, or if it just happens to be a pop-up commercial. But there's this company that's been very aggressively advertising called J.G. Wentworth. Called J.G. Wentworth, 977 cash now, or something stupid like that. But basically speaking, what they do is they offer what's called a viatical settlement, which is they will give you a lump sum of money for your policy now, but you have to turn over everything to them, including any future benefit. You don't get the whole amount. They're not going to give you everything. They're going to give you something, but they're going to keep the rest of the benefits for them. And it can be very, very costly. It can be very, very costly if people want to get out of it. And so that's a viatical settlement. An insurance company can't do it. It has to be done by a third party, which is why these other companies are advertising aggressively towards this, because there's money in it for them. They're not going to give you the full benefit of the policy, and they're going to keep a big chunk for themselves. So you'll get the cash that you need up front, but boy, the cost of it's going to be incredible. So just be careful about that, but that is legal. You can do that. And I'm not going to do the illustration because it's in your book. So there's your tour of life insurance in a nutshell. How'd it go? Questions?